What's going on, dividend chasers? Dividend Bloodhound here with another investing episode. In this episode we are talking monthly dividend stocks and how you can get paid every single month of the year from the food and drink sector. As dividend investors, getting paid monthly is absolutely perfect for us. What we are trying to do is get hold of dividend stocks that will consistently pay us over the years and give us this income, this passive income that we're all striving for, that will eventually allow us to retire early. If you can line the companies up just right, you will receive a dividend check each month of the year, allowing you to add this to your income, or for the moment, at least in my case, reinvest consistently. Now, I've selected 3 companies in this video, all with excellent histories, some slightly better than others, but they all pay and you will get paid every single month of the year. At least with American companies, to achieve monthly dividend stock status in your portfolio so you get paid each month, it's not actually that hard. American companies tend to pay quarterly, so every 3 months you are going to get your check, dividend check anyway. You just need to sort of line them up properly so you get paid sequentially and consequently each month. The first company is Pepsi, an absolute Goliath food and drink company. It's very well diversified. It's not just famous for its famous Pepsi-Cola. It has numerous other brands under its belt, such as Tropicana and Walker's Crisps, which makes it not just a beverage company in terms of drinks, but also well into the food sector as well. This company pays its dividends in January, March, June and September. There is a little bit of confusion around the January and December cut-off times for this company. Sometimes in the past on Dividend Max it's paid very late in December, and then on other occasions it's paid very early January. So just bear that one in mind when you're trying to line this company up to pay you monthly. But you will sort of get the income, get the dividends around this date. So that obviously takes care of 1/3 of the months of the year that you will need to get your dividends on. Without further ado, let's actually get involved. Let's get in the app and have a look at the fundamentals of Pepsi. Hello again, guys, welcome into the app. So here we have Pepsico in front of us. Current share price is $140 a share. It peaked in February this year at $146 a share, and then mid-health crisis it dropped down to $104 a share, which is testament to the strength of this company, that even in the midst of a global pandemic it only dropped $40 off its share price, and then it bounced back from this pretty quickly, as you can see, completing the V-shaped recovery. As I mentioned earlier, you can see some of the more famous brands here in terms of Frito-Lay, Gatorade, Pepsi-Cola, Quakers and Tropicana. But over here in the UK we also have Walker's Crisps to add to that. Its ticker is PEP, has a market cap of $191 billion, a PE ratio of 25.60, revenue of $67.16 billion, earnings per share of $5.41, which is actually reasonably high, which is obviously a good thing, and an EPS yield of a dividend yield of 2.95%. It has net income of $7.31 billion and a profit margin of 10.89%, with a slightly high debt to assets ratio of 81%, nowhere near over 100%, but still a little bit high for my liking, he says, even though I am invested in the company. Now, if we hop on over to the growth metrics, this is a very mature company, so it's already done most of its growing, to be fair. But if we see the revenue growth over the last 3 years, it's been 0.1%. Its revenue growth over 5 years has been 2.26%, But then as we see, EPS growth over 3 and 5 years is 4 and 6% respectively. So it has got a little bit more efficient in that time. The compound annual growth rate, it is quite sluggish in all honesty at 0.73%. But the dividend yield and dividend growth over the last 3 years has been 8.61%. When we factor in that this company has been around for such a long time, and it has been growing its dividends for 47 consecutive years in a row, so it's only 3 years short now of its dividend king status. It's currently a dividend aristocrat, but it's very, very close to becoming a dividend king. So you wouldn't expect to see too much more growth from this company. The share price might grow, but its market it's sort of already got now. But the fact that it's still able to churn out the cash that it is, pay these dividends and grow these dividends for such a long time, it's a fantastic history and is a great addition to the food and drink sector of your dividend portfolio. That being said, I'll wrap up here and we'll move on to the next company. Hey again guys, welcome back. So that was Pepsi there then. Absolutely fantastic company with an awesome history and will make a fantastic addition to your dividend portfolio, paying in the months that I mentioned: January, March, June and September. It is now time to move on to our next company. Our next company, filling in the gaps of February, May, August and November, is Starbucks. Starbucks, as you probably know, is a awesome company, famous for only one thing really, and that is coffee, coffee and more coffee. Really expensive coffee at that, but my gosh, it is delicious. I have an Achilles heel for this company. I know it is bad and I know I should spend more money on investing in the company rather than buying their products, but I really do love a good caramel macchiato. Anyway, I digress a little bit. Awesome company, really good growth credentials coming up over the next few years, beaten up a little bit by the global pandemic as it had to shut a lot of its stores globally. It has 32,000 coffee shops or licensed coffee shops worldwide, which is an absolutely enormous amount, generating a fantastic amount of money. And then not only that, it also has numerous products that are now in supermarkets, at least here in the UK, where you can get, like, they've done a deal with Nescafe, so you can get their pods now for your Nespresso machines. There's also little sachet pods that you can buy that all you need to do is add boiling water. They've sort of crept their way in, not only offering really delicious and expensive coffee on the high street in almost what seems like every street corner, especially in London, but they're now in every single supermarket as well. And I've seen numerous cases of people adding these little cafe sachets and whatever to their baskets. The company has been growing its dividends for 4 years now in a row, and it's been paying for 10 years. It sort of flattened out in 2015 and paid the same dividend twice, so it didn't grow that year. And then from 2014 to 2015, it actually trimmed them down a little bit as well. But this company is still, where I mentioned Pepsi earlier, and the next company, which you might be able to hazard a guess at, but I'm going to let you wait a little bit for that one. This company is very much still in its growth phase. I know I said that it had 32,000 stores worldwide, but that number is still growing. They're still diversifying their product range, whereas Pepsi and the other company, they're well established now. They're not going to go too much further. So you could still get some serious appreciation out of this company's share price as its revenue continues to grow and grow, but they've also started paying their dividends as well, and the plan on growing them consecutively year on year by the look of it. That being said, let's get inside and let's go and have a look in the app. Catch you on the other side. Hey again guys, welcome into the app. So here we have the Starbucks share price currently there, $86 a share. Peak crisis down at $56 a share, and then pre-crisis $93 a share. So it's almost recovered now back to where it was, as a lot of its stores are reopening. Its ticker is SBUCS, SBUCS, X has a market cap of 100 billion, a PE ratio of 32.21, revenue of 26.51 billion, EPS $2.67, dividend yield of 1.91%, and profit margin of 13.58% following a net income of 3.6 billion. Has a high debt to assets ratio though, which is a little bit of a red flag. That's well worth keeping an eye on if you are an investor, but I believe this is because of the debt that they've had to take on to expand at the rapid rate that they have. But you really need to keep an eye on that part of the company and make sure that it doesn't get out of control. I am also an investor in this company. If we now hop on over to the growth metrics side of things, you can see that it's 3 and 5 year revenue growth for 10 and 7% respectively. So double digit growth over the last 3 years is pretty good. Then earnings per share growth at 3 and 5 year is 16 and 15%. That's double digit growth as well. That's fantastic. Company getting more efficient as we go. And a compound annual growth rate of 8.89%. Little bit shy of double digit growth, but nothing to be sniffed at. Really like the good growth value of this company. And then as we look at the last 3 year dividend growth, 21.65% is absolutely great by my book. I know it doesn't quite have the history of Pepsi, having only been growing these dividends for 4 years and paying for 10, but it is starting to build its way there in my opinion. That being said, I'll wrap up and I'll see you back in the outside world. Catch you in a minute. Hello again, welcome back. So that was Starbucks there then. I'm sure you will agree, one of the world's most distinguishable and well-known brands. I have a bit of an Achilles heel for it myself, but at least I'm an investor, so I sort of get paid to drink their coffee maybe. But with the how expensive a coffee is, it would take owning quite a few shares to be able to afford just the one coffee in pound coins per quarter. I've digressed a little bit there, but as you will probably agree, Starbucks, phenomenal company, well worth considering for your portfolio. And as we mentioned, it makes up for the February, May, August and November sectors of this monthly dividend stock portfolio in the food and drink sector. Now then, moving on to the final company in this video. Did you guess it? Do let me know in the comments below if you guessed what the last company was. You could have sort of hazarded a guess based on I said that it had some really good history, or you could have done a process of elimination based on I've already eliminated 8 months of the year with the other 2 companies. Anyway, drum roll please. The last company is, it could be no other, it is Coca-Cola. Of course it is. The red and black bottle, probably the most recognisable drink in the world, and that is saying something considering that I've added Pepsi and Starbucks to this video. But it's just been around for such a phenomenal amount of time. It's a favourite in many households, and it's also a favourite amongst us dividend investors, and I think you might agree, rightly so. It covers off April, July, October and December or January time in our monthly dividend stocks. There again, when I looked on Dividend Max, sometimes it pays late in December, sometimes it pays early in January, and this does swap around every now and again, so just be aware of that if you're trying to reconstruct these stock picks to add to your portfolio. As mentioned, an absolutely fantastic history. Who can argue with 50 plus years of dividend growth, giving it the dividend king status? However, when we look at the metrics, things aren't quite as rosy as they might seem, but there are obvious reasons for this. I mean, for a start, it is such a mature company that we're really not expecting too much more revenue growth anymore, because I think Coca-Cola has already literally taken over the world. So for it to achieve double-digit growth just really isn't likely, but as long as it can continue to generate revenue as it does, I don't think that will be too bad at all. Let's get into the app, let's have a look at the fundamentals, and I'll show you exactly what I'm on about. Catch you on the flip side. Hey again guys, welcome into the app. So here we are looking at Coca-Cola, currently sitting at just shy of $50 a share. Been bobbing along just like that for quite a while now, since it pretty much crashed along with everything else due to the health crisis. Dropped to $37 a share at that point, which was an absolute bargain, I'm sure you will agree. And then just before that, it actually peaked this year at $60. So still $10 off its peak in the last 12 months or so. As I mentioned, it's a glorious company. Like literally the dividend king status of this company almost goes unchallenged and unquestioned. Its ticker is KO. It has a market cap of $214 billion, a PE ratio of 22.84, revenue of 37.27 billion, EPS of 2.18, a nice high starting dividend yield of 3.29, a net income of 8.92 billion, and a profit margin of double digit status, 23.94%, which is pretty good. It has a debt to assets ratio of 78%, so not high as to cause alarm, but still high enough to make you at least double take at it. I would prefer it to be lower, but it's not the be all and end all, especially as the company has the history that it does. If we hop on over to the growth metrics, we remember that this company is a mature company, so we're not expecting too much more in the state of revenue growth, and that's reflected in 3 and 5 year revenue. It's -4% and -3.8% respectively. I'd like to see that a little bit closer to either slow growth or just normal growth rather than being in decline. That does worry investors a little bit, which is probably reflected in the share price. But some better news in the EPS growth of 3 year and 5 year of 5 and 11%. That means that the company is actually more efficient at what it does, which is a good sign. But then if we look at the compound annual growth rate over 5 years, that is -1%. That's also not exactly ideal for what you would look for going forward. And then we have 3 year dividend growth of 4.83%, which is not bad, but also could be better. But then when you factor in the history of this company, is it worth taking on? I still think so, absolutely. It's in my portfolio, but it isn't this steeped in esteem company that a lot of investors give the impression that is. It is well worth always checking and looking into the fundamentals of companies when you are going to invest. But Coca-Cola has been a favourite of mine for a long time, as has the other two, and are all definitely, in my opinion, well worth looking into at the very least, even though I have all three in my portfolio. That being said, I'll catch you back outside. Hello again guys, welcome back to the real world. That was Coca-Cola then, the final company in this monthly dividend stocks video, specifically focusing on the food and drink sector. If you buy all three of these companies, you will get paid every single month of the year. Receive a dividend check in your investing account, ready for reinvesting at least every month. Now, if you replicate that over all the other different sectors that you can invest in, you can see where you could potentially pick up 5 or 6 checks each month. And if you balance that out nicely, you'll get a good foundation going forward to building your dividend portfolio. I really hope you've enjoyed this video today. Do please go and look into Pepsi, Starbucks and Coca-Cola. Well worth a look, and ultimately if you decide not to invest in them, that's fine, but at least hopefully I've given you some ideas to look into to line up your dividend stocks so they can pay you properly and consistently month by month. Hopefully this video has brought you some value. If that's the case, do please hit the like button in the corner and consider subscribing to my channel. That would be great. Been an absolute pleasure as always, guys. Hopefully I'll catch you in another investing episode. Bye bye.